The Asian financial crisis was a period of financial crisis that gripped much of East Asia beginning in July 1997 and raised fears of a worldwide economic meltdown due to financial contagion. The crisis started in Thailand with the financial collapse of the Thai baht after the Thai government was forced to float the baht due to lack of foreign currency to support its currency pegged to the US dollar. At the time, Thailand had acquired a burden of foreign debt that made the country effectively bankrupt even before the collapse of its currency. As the crisis spread, most of Southeast Asia and Japan saw slumping currencies, devalued stock markets and other asset prices, and a precipitous rise in private debt. Indonesia, South Korea and Thailand were the countries most affected by the crisis. Hong Kong, Laos, Malaysia and the Philippines were also hurt by the slump. Brunei, China, Singapore, Taiwan and Vietnam were less affected, although all suffered from a loss of demand and confidence throughout the region. Foreign debt to GDP ratios rose from 100% to 167% in the four large Association of Southeast Asian Nations economies in 1993 to 96, then shot up beyond 180% during the worst of the crisis. In South Korea, the ratios rose from 13% to 21% and then as high as 40%, while the other northern newly industrialized countries fared much better. Only in Thailand and South Korea did debt service to exports ratios rise. Although most of the governments of Asia had seemingly sound fiscal policies, the International Monetary Fund stepped in to initiate a $40 billion program to stabilize the currencies of South Korea, Thailand, and Indonesia, economies particularly hard hit by the crisis. The efforts to stem a global economic crisis did little to stabilize the domestic situation in Indonesia. However, after 30 years in power, President Suharto was forced to step down on the 21st of May 1998 in the wake of widespread rioting that followed sharp price increases caused by a drastic devaluation of the rupiah. The effects of the crisis lingered through 1998. In 1998, the Philippines' growth dropped to virtually zero. Only Singapore and Taiwan proved relatively insulated from the shock, but both suffered serious hits in passing, the former more so due to its size and geographical location between Malaysia and Indonesia. By 1999, however, analysts saw signs that the economies of Asia were beginning to recover. After the 1997 Asian financial crisis, economies in the region are working toward financial stability on financial supervision. Until 1999, Asia attracted almost half of the total capital inflow into developing countries. The economies of Southeast Asia in particular maintained high interest rates attractive to foreign investors looking for a high rate of return. As a result, the region's economies received a large inflow of money and experienced a dramatic run-up in asset prices. At the same time, the regional economies of Thailand, Malaysia, Indonesia, Singapore, and South Korea experienced high growth rates, 8 to 12% GDP, in the late 1980s and early 1993. This achievement was widely acclaimed by financial institutions including IMF and World Bank, and was known as part of the Asian economic miracle. Credit bubbles and fixed currency exchange rates, the causes of the debacle, are many and disputed. Thailand's economy developed into an economic bubble fueled by hot money. More and more was required as the size of the bubble grew. The same type of situation happened in Malaysia and Indonesia, which had the added complication of what was called crony capitalism. The short-term capital flow was expensive and often highly conditioned for quick profit. Development money went in a largely uncontrolled manner to certain people only, not not particularly the best suited or most efficient, but those closest to the centers of power. At the time of the mid-1990s, Thailand, Indonesia and South Korea had large private current account deficits, and the maintenance of fixed exchange rates encouraged external borrowing and led to excessive exposure to foreign exchange risk in both the financial and corporate sectors. In the mid-1990s, a series of external shocks began to change the economic environment: the devaluation of the Chinese renminbi and the Japanese yen due to the Plaza Accord of 1985, raising of U.S. interest rates which led to a strong U.S. dollar. The sharp decline in semiconductor prices adversely affected their growth. As the U.S. economy recovered from a recession in the early 1990s, the U.S. Federal Reserve Bank under Alan Greenspan began to raise U.S. interest rates to head off inflation. This made the United States a more attractive investment destination relative to Southeast Asia, which had been attracting hot money flows through high short-term interest rates, and raised the value of the U.S. dollar. For the Southeast Asian nations which had currencies pegged to the U.S. dollar, the higher U.S. dollar caused their own exports to become more expensive and less competitive in the global markets. At the same time, Southeast Asia's export growth slowed dramatically in the spring of 1996, deteriorating the current account position. Some economists have advanced the growing exports of China as a contributing factor to ASEAN nations' export growth slowdown, though these economists maintain the main cause of the crisis was excessive real estate speculation. China had begun to compete effectively with other Asian exporters, particularly in the 1990s after the implementation of a number of export-oriented reforms. Other economists dispute China's impact, noting that both ASEAN and China experienced simultaneous rapid export growth in the early 1990s. Many economists believe that the Asian crisis was created not by market psychology or technology, but by policies that distorted incentives within the lender-borrower relationship. The resulting large quantities of credit that became available generated a highly leveraged economic climate, and pushed up asset prices to an unsustainable level. These asset prices eventually began to collapse, causing individuals and companies to default on debt obligations, panic amongst lenders and withdrawal of credit. The resulting panic among lenders led to a large withdrawal of credit from the crisis countries, causing a credit crunch and further bankruptcies. In addition, as foreign investors attempted to withdraw the money, the exchange market was flooded with the currencies of the crisis countries, putting depreciative pressure on their exchange rates to prevent currency values collapsing. These countries' governments raised domestic interest rates to exceedingly high levels and to intervene in the exchange market, buying up any excess domestic currency at the fixed exchange rate with foreign reserves. Neither of these policy responses could be sustained for long. Very high interest rates, which can be extremely damaging to an economy that is healthy, wreaked further havoc on economies in an already fragile state, while the central banks were hemorrhaging foreign reserves, of which they had finite amounts. When it became clear that the tide of capital fleeing these countries was not to be stopped, the authorities ceased defending the fixed exchange rates and allowed the currencies to float. The resulting depreciated value of those currencies meant that foreign currency-denominated liabilities grew substantially in domestic currency. currency terms, causing more bankruptcies and further deepening the crisis. Other economists, including Joseph Stiglitz and Jeffrey Sachs, have downplayed the role of the real economy in the crisis compared to the financial markets. The rapidity with which the crisis happened has prompted Sachs and others to compare it to a classic bank run prompted by a sudden risk shock. Sachs pointed to strict monetary and contractory fiscal policies implemented by the governments on the advice of the IMF in the wake of the crisis, while Frederick Mishkin points to the role of asymmetric information in the financial markets that led to a herd mentality among investors that magnified a small risk in the real economy. The crisis has thus attracted interest from behavioral economists interested in market psychology. Another possible cause of the sudden risk shock may also be attributable to the handover of Hong Kong's sovereignty on the 1st of July 1997. During the 1990s, hot money flew into the Southeast Asia region through financial hubs, especially Hong Kong. The investors were often ignorant of the actual fundamentals or risk profiles of the respective economies, and once the crisis gripped the region, coupled with the political uncertainty regarding the future of Hong Kong as an Asian financial center, led some investors to withdraw from Asia altogether. This shrink in investments only worsened the financial conditions in Asia. Several case studies on the topic, application of network analysis of a financial system, explains the interconnectivity of financial markets, and the significance of the robustness of hubs at the main nodes. Any negative externalities in the hubs creates a ripple effect through the financial system and the economy as a whole. The foreign ministers of the 10 ASEAN countries believed that the well-coordinated manipulation of the currencies was a deliberate attempt to destabilize the ASEAN economies. Former Malaysian Prime Minister Mahathir Mohamad accused George Soros of ruining Malaysia's economy with massive currency speculation. Soros claims to have been a buyer of the ringgit during its fall, having sold it short in 1997. At the 30th ASEAN ministerial meeting held in Sabang Jaya, Malaysia, the foreign ministers issued a joint declaration on the 25th of July 1997 expressing serious concern and called for further intensification of ASEAN's cooperation to safeguard and promote ASEAN's interest in this regard. Coincidentally, on that same day, the central bankers of most of the affected countries were at the EMEAP meeting in Shanghai, and they failed to make the new arrangement to borrow operational. A year earlier, the finance ministers of these same countries had attended the third APEC finance ministers meeting in Kyoto, Japan, on the 17th of March 1996, and according to the joint declaration, they had been unable to double the amounts available under the General Agreement to Borrow and the Emergency Finance Mechanism. As such, the crisis could be seen as the failure to adequately build capacity in time to prevent currency manipulation. This hypothesis enjoyed little support among economists, however, who argue that no single investor could have had enough impact on the market to successfully manipulate the currency's values. In addition, the level of organization necessary to coordinate a massive exodus of investors from Southeast Asian currencies in order to manipulate the values rendered this possibility remote. IMF role. Such was the scope and the severity of the collapses involved that outside intervention, considered by many as a new kind of colonialism, became urgently needed, since the countries melting down were among not only the richest in the region, but in the world, and since hundreds of billions of dollars were at stake, any response to the crisis was likely to be cooperative and international. In this case, through the International Monetary Fund, the IMF created a series of bailouts for the most affected economies to enable affected nations to avoid default, tying the packages to currency, banking and financial system reforms. Economic reforms. The IMF's support was conditional on a series of economic reforms, the Structural Adjustment Package. The SABs called on crisis-struck nations to reduce government spending and deficits, allow insolvent banks and financial institutions to fail, and aggressively raise interest rates. The reasoning was that these steps would restore confidence in the nation's fiscal solvency, penalize insolvent companies, and protect currency values. Above all, it was stipulated that IMF-funded capital had to be administered rationally in the future, with no favored parties receiving funds by preference. In at least one of the affected countries, the restrictions on foreign ownership were greatly reduced. There were to be adequate government controls set up to supervise all financial activities, ones that were to be independent, in theory, of private interest. Insolvent institutions had to be closed, and insolvency itself had to be clearly defined. In addition, financial systems were to become transparent, that is, provide the kind of reliable financial information used in the West to make sound financial decisions. As countries fell into crisis, many local businesses and governments that had taken out loans in US dollars, which suddenly became much more expensive relative to the local currency which formed their earned income, found themselves unable to pay the creditors. The dynamics of the situation were similar to that of the Latin American debt crisis. The effects of the SABs were mixed and their impact controversial. Critics, however, noted the contractionary nature of these policies, arguing that in a recession, the traditional Keynesian response was to increase government spending, prop up major companies, and lower interest rates. The reasoning was that by stimulating the economy and staving off recession, governments could restore confidence while preventing economic loss. They pointed out that the U.S. government had pursued expansionary policies, such as lowering interest rates, increasing government spending, and cutting taxes, when the United States itself entered a recession in 2001, and arguably the same in the fiscal and monetary policies during the 2008-2009 global financial crisis. Many commentators in retrospect criticized the IMF for encouraging the developing economies of Asia down the path of fast-track capitalism, meaning liberalization of the financial sector, maintenance of high domestic interest rates to attract portfolio investment and bank capital, and pegging of the national currency to the dollar to reassure foreign investors against currency risk. IMF and high interest rates. The conventional high interest rate economic wisdom is normally employed by monetary authorities to attain the chain objectives of tightened money supply, discouraged currency speculation, stabilized exchange rate, curbed currency depreciation, and ultimately contained inflation. In the Asian meltdown, highest IMF officials rationalized the prescribed high interest rates as follows. For then IMF First Deputy Managing Director Stanley Fischer, when the government approached the IMF, the reserves of Thailand and South Korea were perilously low, and the Indonesian rupiah was excessively depreciated. Thus, the first order of business was to restore confidence in the currency. To achieve this, countries have to make it more attractive to hold domestic currency, which in turn requires increasing interest rates temporarily, even if higher interest costs complicate the situation of weak banks and corporations. Why not operate with lower interest rates and a greater devaluation? This is a relevant trade-off, but there can be no question that the degree of devaluation in the Asian countries is excessive, both from the viewpoint of the individual countries and from the viewpoint of the international system. Looking first to the individual country, companies with substantial foreign currency debts, as so many companies in these countries have, stood to suffer far more from currency than from a temporary rise in domestic interest rates. Thus, on macroeconomics, monetary policy has to be kept tight to restore confidence in the currency. From the then IMF Managing Director Michel Camdesis, to reverse, countries have to make it more attractive to hold domestic currency, and that means temporarily raising interest rates, even if this weak banks and corporations. Thailand. From 1985 to 1996, Thailand's economy grew at an average of over 9% per year, the highest economic growth rate of any country at the time. Inflation was kept reasonably low within a range of 3.4 to 5.7%. The baht was pegged at 25 to the US dollar. On the 14th of May and the 15th of May 1997, the Thai baht was hit by massive speculative attacks. On the 30th of June 1997, Prime Minister Chavali Tongcheriut said that he would not devalue the baht. However, Thailand lacked the foreign reserves to support the USD baht currency peg, and the Thai government was eventually forced to float the baht. On the 2nd of July 1997, allowing the value of the baht to be set by the currency market. This caused a chain reaction of events, eventually culminating into a region-wide crisis. Thailand's booming economy came to a halt amid massive layoffs in finance, real estate, and construction that resulted in huge numbers of workers returning to the villages in the countryside and 600,000 foreign workers being sent back to the home countries. The baht devalued swiftly and lost more than half of its value. The baht reached its lowest point of 56 units to the US dollar in January 1998. The Thai stock market dropped 75%. Finance One, the largest Thai finance company until then, collapsed. On the 11th of August 1997, the IMF unveiled a rescue package for Thailand with more than $17 billion, subject to conditions such as passing laws relating to bankruptcy procedures and establishing strong regulation frameworks for banks and other financial institutions. The IMF approved on the 20th of August 1997 another bailout package of $2.9 billion. By 2001, Thailand's economy had recovered. The increasing tax revenues allowed the country to balance its budget and repay its debts to the IMF in 2003, 4 years ahead of schedule. The Thai baht continued to appreciate to 29 baht to the US dollar in October 2010. Indonesia. In June 1997, Indonesia seemed far from crisis. Unlike Thailand, Indonesia had low inflation, a trade surplus of more than $900 million, huge foreign exchange reserves of more than $20 billion, and a good banking sector. But a large number of Indonesian corporations had been borrowing in U.S. dollars during the preceding years, as the rupiah had strengthened respective to the dollar. This practice had worked well for these corporations. Their effective levels of debt and financing costs had decreased as the local currencies' value rose. In July 1997, when Thailand floated the baht, Indonesia's monetary authorities widened the rupiah currency trading band from 8% to 12%. The rupiah suddenly came under severe attack in August. On the 14th of August 1997, the managed floating exchange regime was replaced by a free floating exchange rate arrangement. The rupiah dropped further. The IMF came forward with a rescue package of $23 billion, but the rupiah was sinking further amid fears over corporate debts, massive selling of rupiah, and strong demand for dollars. The rupiah and the Jakarta Stock Exchange touched a historic low in September. Moody's eventually downgraded Indonesia's long-term debt to junk bond Although the rupiah crisis began in July and August 1997, it intensified in November when the effects of that summer devaluation showed up on corporate balance sheets. Companies that had borrowed in dollars had to face the higher costs imposed upon them by the rupiah's decline, and many reacted by buying dollars through selling rupiah, undermining the value of the latter further. In February 1998, President Suharto sacked Bank Indonesia Governor J. Sodrojat Jivandono, but this proved insufficient. Suharto resigned under public pressure in May 1998 and Vice President B.J. Habibie was elevated in his place. Before the crisis, the exchange rate between the rupiah and the dollar was roughly 2,600 rupiah to 1 U.S.dollar. The rate plunged to over 11,000 rupiah to 1 U.S.dollar on the 9th of January 1998, with spot rates over 14,000 during 23 to 26 January and trading again over 14,000 for about 6 weeks during June to July 1998. On the 31st of December 1998, the rate was almost exactly 8,000 to 1 U.S.dollar. Indonesia lost 13.5% of its GDP that year. The crisis also brought independence to East Timor, South Korea. The banking sector was burdened with non-performing loans as its large corporations were funding aggressive expansions. During that time, there was a haste to build great conglomerates to compete on the world stage. Many businesses ultimately failed to ensure returns and profitability. The chaebol, South Korean conglomerates, simply absorbed more and more capital investment. Eventually, excess debt led to major failures and takeovers. For example, in July 1997, South Korea's third-largest car maker, Kia Motors, asked for emergency loans. In the wake of the Asian market downturn, Moody's lowered the credit rating of South Korea from A1 to A3 on the 28th of November 1997, and downgraded again to B2 on the 11th of December. That contributed to a further decline in South Korean shares since stock markets were already bearish in November. The Seoul Stock Exchange fell by 4% on the 7th of November 1997. On the 8th of November, it plunged by 7%, its biggest one-day drop to the date, and on the 24th of November, stocks fell a further 7.2% on fears that the IMF would demand tough reforms. In 1998, Hyundai Motors took over Kia Motors. Samsung Motors' $5 billion venture was dissolved due to the crisis, and eventually Daewoo Motors was sold to the American company General Motors. The South Korean won, meanwhile, weakened to more than 1,700 per U.S.dollar from around 800. Despite an initial sharp economic slowdown and numerous corporate bankruptcies, South Korea has managed to triple its per capita GDP in dollar terms since 1997. Indeed, it resumed its role as the world's fastest-growing economy. Since 1960, per capita GDP has grown from $80 in nominal terms to more than $21,000 as of 2007. However, like the chaebol, South Korea's government did not escape unscathed. Its national debt-to-GDP ratio more than doubled as a result of the crisis. In South Korea, the crisis is also commonly referred to as IMF. Philippines. The Bangko Sentral raised interest rates by 1.75 percentage points in May 1997 and again by 2 points on the 19th of June. Thailand triggered the crisis on the 2nd of July and on the 3rd of July, the Philippine Central Bank intervened to defend the peso, raising the overnight rate from 15% to 32% at the onset of the Asian crisis in mid-July 1997. The peso dropped from 26 pesos per dollar at the start of the crisis to 46.50 pesos in early 1998 to 53 pesos as in July 2001. The Philippine GDP contracted by 0.6% during the worst part of the crisis, but grew by 3% by 2001. Despite scandals of the administration of Joseph Estrada in 2001, most notably the Dueteng scandal, causing the PSE Composite Index, the main index of the Philippine Stock Exchange, to fall to 1,000 points from a high of 3,000 points in 1997. The peso's value declined to around 55.75 pesos to the US dollar. Later that year, Estrada was on the verge of impeachment, but his allies in the Senate voted against continuing the proceedings. This led to popular protests culminating in the EDSA-II revolution, which affected his resignation and elevated Gloria Macapagal Arroyo to the presidency. Arroyo lessened the crisis in the country. The Philippine peso rose to about 50 pesos by the year's end and traded at around 41 pesos to a dollar in late 2007. The stock market also reached an all-time high in 2007, and the economy was growing by more than 7%, its highest in nearly 2 decades.